Welcome to this explainer. Whenever we look at a company's financial statements, we fundamentally trust those numbers for one big reason: the auditors standing right behind them. But have you ever wondered about the actual rules governing these financial detectives? Well, today we're going to completely unpack the dense regulatory framework that surrounds them. We're going to follow the high-stakes life cycle of a corporate watchdog, making the whole thing clear, structured, and honestly, a lot easier to digest.
So here's how we're going to tackle this today. We're going chronologically. First, hiring the watchdog. Then we'll get into ethics and independence, followed by fraud and errors, some industry-specific rules, and finally, the auditor's exit. Let's get right into it.
All right, Section 1, hiring the watchdog. Okay, so before an auditor even accepts a job, they have to rigorously screen the prospective client. They can't just jump in and say yes to anyone. They've got to assess the business risks and, crucially, seek references. Now, this actually involves asking the client for permission to talk to their previous auditor. And get this, if the client says no, that is a massive red flag, and the auditor should absolutely just walk away. But if they're cleared, the auditor then formally defines their duties in what's called an engagement letter. This is super important because it draws a hard line between what the directors are responsible for and what the auditors are responsible for, saving everyone from some very costly misunderstandings down the road.
But who actually gets to be this watchdog? Well, according to CAMA, the Companies and Allied Matters Act, it's definitely not a free-for-all. Some of the exclusions are pretty obvious, right? Like infants or persons of unsound mind. But notice that an officer of the company, an undischarged bankrupt, or even a body corporate, which is just the legal term for another company, they are all strictly barred from taking the role. The law demands a qualified, independent, human professional who basically has zero financial vulnerabilities.
Moving right along to Section 2, ethics and independence. 15%. Remember that number, because it is a hard, non-negotiable boundary in the auditing world. Recurring fees from one single client should literally never exceed 15% of an auditing firm's gross practice income. And if you're auditing a public company, that threshold drops even further down to 10%. Why so strict? Because if a firm is relying way too heavily on just one client to keep the lights on, well, they might be tempted to look the other way just to keep that client happy. So, financial independence is exactly what ensures objective reporting.
But honestly, the threats to an auditor's objectivity, they go way beyond just relying on fees. Objectivity can be shattered by things you might not even think about right away. For example, overdue fees. If a client owes the auditor a massive amount of money, that essentially acts like a loan, totally compromising their independence. Other threats, having family members working as senior officers for the client, personally holding shares in the company, or even just accepting lavish gifts or hospitality. An auditor's objectivity doesn't just have to exist behind closed doors. It must be clearly, undeniably seen by the public.
Next up, Section 3, fraud, errors, and laws. Now that we've got our auditor hired and operating independently, we really need to ask a fundamental question about their day-to-day job. What exactly differentiates a simple, honest mistake from actual full-blown corporate fraud? Well, it all boils down to one word: intent. An error? That's just an unintentional math mistake or maybe misreading a company policy. Fraud, on the other hand, is the intentional use of deception to gain an unjust advantage. We're talking about falsifying documents or skimming assets. Now, it's really important to understand that it's technically the company director's job to prevent fraud using internal controls. The auditor isn't a daily security guard, but their very presence acts as a massive deterrent. They have to constantly apply professional skepticism and basically design their entire audit to sniff out both those accidental errors and the really clever intentional deceptions. So, what happens if our detective actually uncovers fraud or some major rule breaking? They definitely don't just keep it to themselves. There's a very strict reporting chain. First, they take it straight to management. If management is somehow in on it, they escalate up to the board of directors or the audit committee. But what if the whole board is compromised? In those extreme worst-case scenarios, the auditor has to weigh their duty of client confidentiality against the greater public interest. And if the public is at risk, they are completely legally protected to break confidentiality and report directly to authorities like the police, the central bank, or the Serious Fraud Office. It's all about protecting everyday stakeholders.
Let's pivot a bit. Section 4, rules by industry.
Because you might be wondering, just how high are the stakes here? Well, under the Financial Reporting Council Act, they are sky high. If an auditor or a public interest entity fails to comply with accounting standards, it is absolutely not a slap on the wrist. We're talking about severe penalties. Non-compliance can trigger a massive 10 million naira fine, up to 2 years in prison, or even both. The law does not mess around when it comes to enforcing financial reporting standards.
And the rules get even tighter depending on the playing field. Take the banking sector. Under BOFIA, the Banks and Other Financial Institutions Act. Because banks hold your money, an auditor here must actually be specifically approved by the Central Bank of Nigeria. They've got to ensure the bank's accounts are published within 4 months of the year end. And most importantly, if they discover that the bank's capital is suddenly dropping, or if there are irregularities that jeopardize depositors' money, meaning your everyday checking accounts, they bypass standard protocols completely and must report it immediately to the CBN.
Then you have the insurance sector, which brings in a whole different set of metrics. Under the Insurance Act, an auditor has to verify some pretty massive minimum paid-up capital requirements. Basically, checking if the company actually has the cash on hand to pay out your claims. For example, a life insurance company needs at least 8 billion naira, while a reinsurance business needs a staggering 20 billion naira. The auditor also has to verify provisions for unexpired risks, which just means making sure the company stays solvent enough to protect policies that are still active.
Which brings us to our final phase. Section 5, the auditor's exit.
Every life cycle has to end, right? An auditor's exit usually falls into one of two buckets, resignation or removal. With resignation, the auditor is choosing to leave, and they have to officially deposit a written notice at the company. But removal, this is fascinating. Directors cannot simply fire an auditor just because they disagree with them or don't like what they found. To completely preserve that crucial independence we talked about earlier, only the shareholders can remove an auditor, and they have to do it through an ordinary resolution at a general meeting.
And listen, removing an auditor is absolutely not an instant overnight thing. There is a very strict statutory timeline designed specifically to ensure fairness. It kicks off with a 35-day notice of the intention to move the resolution before the annual general meeting even happens. Then, members are formally notified 21 days out. Crucially, the auditor actually has a statutory right to be heard orally and to submit a written defense to the shareholders. And if they are finally removed, the company has exactly 14 days to notify the Regulatory Commission. The whole process is built so directors can't just quietly sweep a strict watchdog under the rug. But what if the auditor is the one who wants out? In this profession, resigning midterm is considered a massive step of last resort. It's a huge deal. When an auditor resigns, the law forces them to produce a statement of circumstances. They have to explicitly lay out if there are troubling, hidden reasons behind their sudden exit that the shareholders and creditors really need to know about, like, say, management hiding losses or shredding documents. If those reasons exist, that statement has to be circulated, which basically sounds a massive alarm bell to the entire financial market.
So we've seen how they get hired, the absolute ethical tightropes they walk, how they hunt for fraud, and how their life cycle eventually ends. This entire regulatory framework is custom-built to force corporate transparency. But honestly, it leaves us with a pretty provocative final thought. With so much of our economy, our personal bank deposits, and our investments completely relying on their independence, their ethics, and their ability to catch fraud, how can we ensure the watchdogs themselves remain incorruptible? It's the ultimate question, and it's one that continues to shape the entire future of financial regulation. Thanks so much for joining me for this explainer.